Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Okay, so US stocks once again unchanged as that expiry pin continues to hold the market into expiry. Something that was also backed up by my friend from Spot Gamma, Brent Kachuba, in the conversation we had yesterday on YouTube. We think it's likely that the market's going to struggle to shake these levels off until after Friday. And then it should probably be a bit freer to move. This is a phenomenon we often see in expiry when markets move into an area where dealers are caught long optionality and it becomes a bit self-fulfilling. And the realized vol collapsing the way it has certainly backs up that theory. European stocks were down overnight. ASML, the biggest name in the Euro stocks, dropping on some earnings guidance. The VIX did hit a 16 handle yesterday. We've got a VIX expiry this morning. As I said, it did look like that was the way we were going. Dealers looked like they were offloading VIX futures against the charm of the VIX options on the April expiry. That seems to be done now, and we have seen a reaction in the VIX higher overnight. So it may well be that that's exhausted itself, the futures selling, and we might have seen a local bottom in vol. Now, the fact that we are likely to stay pinned, though, on the S&P may mean that vols still don't run away to the upside until maybe next week, but just something to be aware of. We often do see local lows in vol around VIX expiry. We saw Netflix earnings as well overnight. They were mixed. The stock did knee-jerk lower by about 10 to 12%, but then bounced straight back. So it's showing pretty much unchanged right now. Gold was also lower overnight. The whole commodity complex is seeing some weakness on the back of some dollar strength and real yields moving higher yet again. And then China was also pushing back against higher iron ore prices. So that would impact like the industrial metals space. We've already said vols in equities, generally down sort of quarter to half a point across all the indices. Commodity vols were also down across the board, except for oil. Oil vol is pretty much in the lows right now, going back the last year and a half. So it does start to look interesting value, oil vol, if you do think oil has got a move in it. And then looking at carry's still in positive territory everywhere except for China and in nat gas, which is down to a 72 vol, which might sound high compared to every other asset, but for nat gas, that's quite low. And the fact that it's realizing 80 means we flip back into negative carry. Skew having a rare bounce in equity, in US equities anyway. Traders more willing to sell upside vol because they're probably long that stuff and they're not really so long the downside. So that's where we're seeing skew. I don't think it's really put demand coming in. It's just that the sellers of puts have kind of gone away because at these low vol levels, they're going to sell the stuff they actually own, and that tends to be more upside strikes. Silver and copper skew finding a small bid. Nat gas skew dropping down off the highs as the spot move continues to come to the upside finally. So we may be in for a bit of strength in nat gas now, finally shaking off those lows. Let's see if this thing can actually stage a meaningful bounce. Okay, what else are we seeing? Bank of America put out their fund manager survey showing that sentiment has turned south again in April. And remember, these are just surveys, so they don't necessarily reflect people's positioning. It's more like what they feel like saying in public, these surveys. So some people say that there's not that much signal value in these things, but, always worth keeping an eye on, in my opinion, to see what they're saying. But given the bearish sentiment that we are seeing, and it's, the most pessimistic so far this year, it basically suggests that it's going to be hard for markets to sell off materially unless recession expectations are met quickly. Okay. So, and even if that does happen, if we do start to see the growth data roll over and employment data roll over, it really does depend on the speed of the Fed's reaction. And if the rates market assumes that the Fed is going to react quickly and take rates down fast, then that will likely be supportive for the tech sector and probably for the broader indices. Right? Speaking of the tech sector, long big tech seems to be the most crowded trade, along with long China and short banks from the fund manager survey. This might mean that in an upside move in the market, the tech rally is more limited because everyone's starting to own it. I'm not so sure about that, whether they really own it, right? There's definitely been a rotation back into tech, which is why tech has outperformed. But I think there might still be legs in that trade in terms of retail going really after it again as well, right? And we know that retail can move the market. Depending on earnings as well. Earnings kick off next week in the big tech names. We have obviously just had Netflix. We've got Tesla tonight, but then your big Microsoft, Google's, Amazon's, etc. They all kick off next week. Either way, we see room for decent sized swings after the market gamma unclenching happens on Friday. Clearly, there's a ton of gamma that's going to be rolling off on Friday. This is what's keeping the market here, we believe. And so once that happens, we think the market might move to the upside or the downside, but it'll just be a bit freer to move. And that's why we are looking for ways to lean longer volatility. We have been long VIX puts. We got out of them yesterday. That seems to have been a timely move. And we are looking for smart ways to accumulate some long vol for maybe the next 2 to 3 weeks, right? I'm not going to get married to the position, but just tactically, for me, vol looks a bit oversold. So I'm looking for ways to own some right now. Okay, right. So where's the question then is if you're looking to buy vol, where's the cheap vol? Okay. And if we screen across all our vol dashboards, there's certainly a lot of low implied vol, but is it necessarily cheap, right? Those who've traded options long enough, like myself, will know that low vol tends to be dangerous to buy because it's low for a reason, right? If dealers often get oversupplied with gamma because of institutional selling, and then you get really low realized vol and low implied vol, it becomes somewhat self-fulfilling, like what's happening on the S&P right now from the dealer hedging activity. And really owning S&P vol at these low levels doesn't look very appealing because the street owns it, okay? Ironically, in low vol environments, it makes more sense to buy the higher vol options because they're trading at a vol premium, which is telling you that people just don't own them as much. And therefore, the probability of getting larger moves in those assets is actually higher, right? Because you don't have this massive supply that makes the market hard to actually move. With markets having rallied recently, VIX has obviously been crushed. Equity skew is still elevated relative to other asset classes, even though it's come back down to like the 20, 30th percentile. Short dated upside is naturally going to be the cheapest part of the vol surface in equities. So what we do is we've compared the 105 calls in the 2-month expiry. 1 month's a bit too short for me because, you're going to run out of Vega exposure on the 1 month very quickly. So I prefer to go for 2 month, and that also means I'm not so long gamma paying so much decay. So anyway, owning that 105 call in the 2 month, looking at those across NASDAQ, Russell, you can see S&P's at a 12 and a bit vol. The other two are around 17 something. So there's a good 5-6 vol premium between the NASDAQ and the Russell over the S&P. But we like those better. Looking at it, homing in on the NASDAQ itself, you can see, right, NASDAQ's trading here at 13,000. If we were to rally 5%-ish to up here in the high 13s, look where the vol is, right? It's at 18 vol, 17, 18 vol. And look where it's been for the last few months, right? So all of those observations of vol, pretty much all above 20. So what I'm saying to you is if we were to rally post expiry and go there, I wouldn't be surprised if the vol kind of floats and that 18 vol level doesn't materialize and the vol actually catches a bit of a bid, right? So that's kind of what I'm thinking makes sense to own that upside in NASDAQ. All right. Now the question is, if you do own vol, and I'm not talking about owning upside naked calls here, right? This is not a delta trade. We're talking about trying to identify a good value volatility trade. So you would have to actually delta hedge this trade, okay? So if you're going to delta hedge the upside, then you're going to be trading the realized volatility like the dealers do, basically, right? So the idea is you buy the upside calls, you delta hedge them, and then you basically trade, you rebalance the delta hedge based on how much the market moves, and then you monetize the realized vol. This is something that we cover in our options trading bootcamp. We've got one coming up at the end of April, but this is a type of dynamics we explain more thoroughly about what dealers are doing, how they're hedging their gamma, why they're hedging their gamma, things like that. Anyway, looking just at realized volatility, if we look back the last 10 weeks, right? Let's say, let's look at 50 trading days, for example, okay? Then you can see the realized vol on S&P is 15.8, 19.5 on NASDAQ, 22 on Russell. That's based on hedging every single day. That's the realized vol you would capture. Now, you don't actually have to do that. If you believe that the market actually has bigger swings if you let it just go and hedge it on a weekly basis, then there may be potential to make more money when you're long gamma by hedging every week rather than every day. Now, doing that calculation, if I look back on a weekly basis at the last, again, 10 weeks, then I actually see that we do capture more volatility, right? We get 17.6 on S&P, 21.9, so about 2 vol premium above if you were hedging on a daily basis, if you hedged it every week on S&P and NASDAQ. And if you did that on the Russell, you got an extra 4.5 volts. So now that doesn't mean that's always going to work, right? Sometimes waiting a week to hedge, you're going to see mean reversion throughout the week, and then you're actually going to lose out the ability to capture some P&L. So it depends on what you think about the market and how you think market's going to move. But from my perspective, I think right now, I probably wouldn't be hedging on a daily basis. I would kind of let the market move away from these levels, find a new level of equilibrium before I do a hedge. So I think hedging on a weekly basis is going to be a better way to manage a long gamma position going forward. All right, looking at our strategy compass, looking at our dashboard for NASDAQ, what do we see? Vol's at 20 at the money. We already said the upside's more like 18 vol. Clearly, it's telling you buy puts right now because it thinks spot is obviously stretched to the upside. But from our perspective, we just think a break to the upside may well be on the cards just because there is a lot of bearish sentiment out there still. And if earnings next week come out strong out of these mega cap techs, then get out the way because these things probably do have some more upside to go. Okay, so I'm not fading this thing from a delta perspective, but what I do like is the idea of owning that vol because I think the swings can come in either direction. And I think the implied volatility has got sold off enough that it just doesn't have a ton of downside. All right, thanks a lot. I'll catch you all tomorrow. Cheers.